So you want to be a Forex trader. Hey everyone, this is Josh Martinez from Market Traders Institute. This is video number 12. We're going to be putting everything together. Hopefully this series has really assisted you with knowing where to find your software, what to look for, how to choose a broker, how to apply hand-drawn trend lines, what you're actually looking for when you look at a chart, how to read Japanese candlestick formations, Fibonacci, support resistance, larger time frames, smaller time frames. And so now what we're going to do is we're going to put it all together. I'm going to jump into the actual computer and I'm going to show you on live charts in just a few moments of how we analyze the market on a daily basis. I can give you 1 or 2 examples. This video I would imagine to be a little bit longer because I do want to spend a little bit more detail. And this will be the last video of our series. So let me know what you think. Let me know in the comments below. You can always find me on Facebook, www.facebook.com/FXPathfinder. You can find me on Twitter, Blab, social media. And thank you so much for watching. All right, so let's get started. In front of you is the ultimate charting software. It's the charting software in which we've created here at Market Traders Institute. We love it, hands down, fantastic. It's out of the box, user friendly, which basically means like your cell phone. You just basically get your cell phone and you kind of just figure it out. And it doesn't take a long time. So we're going to be looking at, what do you say? Let's just do like 2. Let's look at 2 currency pairs. Maybe take a little bit longer, but I'm going to bring everything together for you of all the lessons of So You Want to Be a Forex Trader. And we'll start with the Great British Pound Canadian Dollar. And I look at the monthly time frame for direction. And so the very first thing I'm going to do is bring up the Great British Pound Canadian Dollar. And I'm going to say, well, let's take a look at it. We have the market. Oh, and by the way, I'll take wonderful notes here. So monthly time frame will equal direction. And what I'm specifically looking for off the monthly time frame is I'm specifically looking for U-turns. I want to see if this market is hitting a D extension. I want to know where the next D extension is using Fibonacci's. I want to use future resistance, which is a fancy word for future high, and future support, which is a fancy word for a future low. So I'm going to be using hand-drawn trend lines and so on and so forth. So when I look at this trend, first thing I'm going to do is put on our Fibonacci's. Now we've automated our Fibonacci's to where it's just one click. You find the lowest point of the trend, you click on it, you can see right away. If you missed it, I'll do it again. I just find the lowest point of the trend, left click, boom, within a half a second, fraction of a second, everything's applied. That saves literally hours and hours and hours of analysis, especially when you're looking at multiple currency pairs. And you're 100% correct. So that's very wonderful in which we saw. So right now we have this market making higher highs and higher lows where bulls are in control. And the direction says, hey, look, we have an up AB boundary. We have a 786. We're touching a 786, but the market hasn't U-turned yet. With the 786 retracement, we'll make our D extension D 1.618, and that will be an overall target of, actually not 1.618, the 1.27 will be the D extension, so our target will be 2.1899, which is going to be that 1.27, because 382s, 50s, 618 retracements all go to the 1.618, 786 go to the 1.27, and the 86 goes to 1.18. We've highlighted ours, so red goes to red, blue goes to blue, and green goes to green. So how far away is that opportunity? Well, let's bring out a calculator. And let's just take the target of 218.99 minus current price point, which is 1.8154, 3,745 pips. 3,745 pips. As you know, if you're trading $10 a pip, which is basically where every investor is searching to go towards, at least, right? That's going to be $37,450 US of opportunity. Quite nice. So now we need to bring in the supporting evidence of everything that we've learned from the So You Want to Be a Forex Trader series, and let's get to work. Well, first things first, you're going to visually view the market, and you're going to just basically say, hey, the market's making higher highs and higher lows, higher highs and higher lows, higher highs. and higher lows, higher highs, and higher lows. And you can see we have a wave pattern that our jobs as investors is to buy low, buy low, buy low, buy low. So many traders look at this and they will say, well, you know, Josh, the market has fallen bearish over 2,900 pips. Let's just sell the market. And I'm kind of like, whoa, we've fallen 2,900 pips. Why in the world do you want to sell this market? We're in an uptrend. This is a short-term retracement. We got to be looking for the reversal. Now remember the lesson where we talked about Gartley's, where it's the movement from the capital B to the capital C. So we'll put up our Fibonacci's once again. And from our Fibonacci's, you can see that, hey, this market's moving from the capital B to the capital C, and that this movement, this wave pattern from the B created a Gartley, which is your sub ABCD swing, helping you identify the C. Well, your extension has been fulfilled, which is basically eliminating the reasons why the market's going to fall. Remember also in the lesson that we talked about resistance becoming support, where you have past lows becoming future highs. Look at this red line. You got a high, you got a low, and we're touching it right now at the market, making lower lows and lower highs, hitting a Gartley D at the market at a 786 retracement, where the market has already exhausted a 3,000 pip, 2,900 pip movement. It's kind of like there are no more reasons why the market should fall bearish. It's time to look for this market to go up. So direction is up. We're going to expect the market to rally 3,745 pips for all the reasons that we just explained. Percentage-wise, now there's no such things as 100% absolutes or guarantees, but you know, basically when you say, you know, you got an 8 out of 10 chance the market's going to do something, you probably should trade in that direction because it's an 80+% chance. And if you did this scenario 100 times, more times the market will go up rather than it will go down. So equity management is absolutely going to protect us in case we're wrong. We'll talk about that in just a few moments. But the direction is up. And I always ask this question. If we're going to expect this market to go up 3,745 pips, do you want to buy low or do you want to buy high? Do you want to buy low or do you want to buy high? That's the question that you have to ask yourself. Are you going to buy low or are you going to buy high? Everyone says, Josh, of course I'm going to buy low because, you know, I want to make money when the market's at a high price. You're right. But the issue is traders don't know which time frame to find your high prices and low prices. What we've discovered over the years is that the daily time frame is a great time frame to use to find your high and low prices. Okay? And so we're going to use the daily time frame, and we are interested when the market's low because we want to buy low, and we are not interested in trading at the market's at a high price. Now, no one is disagreeing. This market on the daily time frame, which is that bottom chart, is going down. No one's arguing with this, right? No one's saying it's not going down. What we're saying is the market is falling. The market is making lower lows and lower highs. You have your two different set of trend lines which the market's following. Look how you have resistance, resistance, resistance. That's your outer trend line. You have an inner trend line, okay? We'll focus on an inner trend line. What we're saying is this. It's a really, 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 really bad idea to sell the market. Why? Because of all the reasons why we just stated off the monthly time frame. The monthly time frame is hitting resistance, becoming support. The monthly time frame fulfilled a Gartley. The monthly time frame is at a low price. The monthly time frame is fallen 3,900 pips. A reversal is coming. And so an intelligent trader, when you put this all together, is going to say, I got to stop selling and I got to look to buy. And we're expecting this to become a low price. Now, I'm not saying jump into this market. What I'm saying is don't sell the market and wait for the reversal. And if you see a bullish reversal, take it seriously. Okay? Now, when we view where the market could go, you have to understand the market moves in waves. It does not move in straight lines. It likes to make lower lows and lower highs on the way down, and it likes to make higher highs and higher lows on the way up. And it likes to do this with inside of the same areas. Hence, support become resistance. This red line is an area where the market has formed a low, it's formed a low, it's formed a low, it's formed a low, and has forced this market to U-turn. It has also prevented the market from falling, and then prevented the market from going up. What we are saying, and what I'm saying is, this is your next high spot. This market is going to press up, break this trend line, test the backside of the trend line, and press just like that. And then this is where the red line is where this market's going to have hesitation. Now that red line is going to be 8508. 1.8508 is going to be the future high price. That is what we are looking for. And how far away is that? That is going to be 8508 minus where we are now, 8145, 1,363 pips. 1,363 pips. So what do we need to do to enter into the market? And by the way, if you traded $10 a pip, that's $13,630 US dollars. So what do we need to do to make this? Because this is going to be within a 30-day period. You can make $13,000 off of this move if the trade presents itself. Now you got to ask yourself, it's a serious question. How hard do you want your trading? Do you want trading to be a little easier than the average person, or do you want trading to be tough? If you try to buy the market right now, your trading will be tough. If you let the market enter into the buy zone, let the market form a low price higher than the last low in the buy zone, and then you start buying counter trend line breaks bullish where you see green, I highlighted the green, you will have a fun and exciting ride towards the north, and you can begin to buy counter trend line breaks bullish. What does that look like? Okay, so basically what I'm saying here is this. If the market is in the buy zone, testing the backside of the trend line, we are going to turn to the 1 hour time frame for entry. Now remember, monthly time frame says we're going up. Daily time frame gives us high prices and low prices. We have our low price. We know where the next future high price is. We know exactly where the market needs to be, where we need to start buying the market. We're waiting for the market to get there. But if the market is at the low price, what would we do to buy the market? What would we look for to buy the market in the smaller time frames? I want to use this bearish trend for an example. I like to use counter trend line breaks to enter in, whether I'm selling or whether I'm buying. So if you look at this, you can just say every time the market retraces, we bring in a counter trend line. And if or when the market breaks and closes below a counter trend line, provides a selling opportunity. If you look at your screen and you say to yourself, if I were to sell any of these counter trend line breaks, could I have made some money on the way down? Most individuals look at this and they say, yes, I could. But then also, you know, like the salty individuals out there, the people who have a lot of experience of losing money and not being successful, what do they say? And if this is you, this is hard truth. Yeah, anyone has hindsight in 2020. Okay, great. Anyone has hindsight in 2020. Are you done? Or are you ready to learn how to do this in the future? Because the difference between doing this and looking at this hindsight and actually doing this is doing it. Because we're going to have the same exact trend on the way up. The same exact trend on the way up. The question is, are you going to have enough belief to do it? To where when after you've made all your profits and after you've made your 1,300 plus pips when the market presses to the future high price, and you sit back and you go, wow, that was fun. I cannot believe I won so many of these trades. I cannot believe how well that worked. What a sigh of relief, because now I am successful. I have a strategy that is just producing consistent, reliable income. Do this for an entire year. Build your track record, build belief, build confidence, and then say, I can't wait for tomorrow, because tomorrow I tell my job that they're fired. You see what I'm getting at here? And so, yeah, you can take the salty attitude of, oh, that's hindsight's 2020, or you can actually look at it and then you can say, wow, this works so darn good. This is unbelievable. This just works hands down. It is just, wow. Let's do that. Yes, so let's do that. So if the market is to be at the backside of the daily downtrend line, to giving us the buying opportunity, to giving us the green light, so that we can make 1,300 plus pips buying the low price to the future high price. Look at your day, your 1 hour time frame, and this is what you would look for. You would look for this market to break your downtrend line. Well, let's bring this in. Bring in more bars. You'd wait for the market to break your downtrend line, which is this downtrend line. As the market's making lower lows and lower highs, you really don't want to buy the market when you're in a sell zone. You want to wait for the market to break the downtrend line, enter into the buy zone, test the backside of the trend line, and start buying counter trend line breaks bullish for the next 1,300 plus pips. And then you too, as an investor, can have the same success that many of our MTI investors have, because this is a big part of what we teach them. We want to buy these lows. Now, let's focus in on the next low, or the first low, the first entry. We're going to say the following. We're going to let the market enter into the buy zone. We're going to let the market break a counter trend line bullish in the buy zone. If you enter in earlier than this, you're breaking the rules. Entry, waiting for the market to enter into the buy zone. Then looking to buy when or if the market breaks and closes above the counter trend line bullish. Stop. Stop will go 10 pips below, 10 pips below low of U-turn. So if this is your entry, whatever the low that formed before the counter trend line break, or the lowest point, just 10 pips below there. So 42, 32. So that's your low, 10 pips below there. Then measure from where you bought to where your stop price is. This is going to be about an 80 pip risk. Risk is 80 pips. Reward will be 3 times the risk. And so the reward will be 240 pips. The reward average pip size of $10 will be 2,400 US dollars. Now, I want you to think about the logic behind this as I'm setting this up. I am looking to win 3 times the amount that I lose. 240 would be 84.33. 84.33. 84.33. Which means if I were to place this trade 10 times, all I have to do is win 3 out of 10 trades, and I will generate a profit. This means I'm able to lose 70% of my trades, and I can still make money. That is such a relief off the shoulders. That's no pressure. Heck, I can luck into winning 3 trades. Now, I have a track record of winning between 65 and 75% of all my trades, but I prepare myself to still grow my accounts, only winning 30%. That's important because you can have a really fun time and feel so accomplished in the market when you're consistently generating money. But you have to have the mindset to say, one trade is not going to make or break me. One trade's not going to pay my bills. If I were to lose 7 trades, it's not going to make or break me. 7 trades are not going to pay my bills. If you lose 7 trades and it wipes out your account, that's shame on you. Trade with a good lot size. Get your equity management in line because you're over leveraging. That's not of staying power. 30 to 50 trades. You place 30 to 50 trades. That's where you find your formula. That's where you see how much money you can really make in this market. You can see how many trades you're really going to win. And then you can judge based upon your habits on whether or not that you are going to be prepared in X amount of time to retire. and have this to be a reliable income source. If 30 to 50 trades, you're all over the place and you have huge swings up and huge swings down, something's obviously is broken. Whether it's equity management, you got to lower your lot size. Whether you're not being consistent with your rules, your strategies, if you're bouncing all over the place, it's really hard for anybody to be successful if you're scalping one day, swing trading the next day, position trading, then day trading. Stick to one strategy. Stick to one methodology. Place 30 to 50 trades. Follow the rules. Have a good equity management plan. You will see how much money you can potentially make. And if you're not making any money, then throw that strategy away because it's not for you or it's just no good in general. So let's go ahead and move on to the next one. We'll do one more and then we'll call this a wrap. We'll pull up the Euro NZD. Same thing. We're going to do a little bit faster this time because we're already 20 minutes to the presentation or the video. We'll have Euro NZD monthly time frame, simple. We're going to find direction. Market has broken a downtrend line. Market has entered into the buy zone. Took out this high, higher than all these other highs. 1, 2, 3, 4. Formed a low, higher than this low. We got an up AB boundary. Great Fibonacci, by the way. We got ourselves a little 5-0 retracement. D extension is the 1.618. So our target is going to be 2.1444. 2.1444 is going to be the target. And if we minus that 214.44 minus 6399, that's 214.44 minus 1.6400, 5,044 pips. So it's 5,044 pips to be had. That's over 50,440 US dollars. Now we need to stay focused on buying low on the smaller time frames. We're going to look at the daily time frame to see, hey, if the daily time frame is at a low price, we're interested in buying. If the daily time frame is at a high price, we got to wait. When I look at the daily time frame, all I want to know, are we high or are we low? If I take a look at the current market condition, clearly we're consolidating. We have support and resistance, resistance and support. When the market touches the top blue level, the market falls. When the market touches the bottom blue level, the market rallies. Since I'm expecting this market to go up for 5,000 plus pips, I'm only interested in buying. So we're at a low. Let's look to buy. Why? Because if I would have bought low to resistance, I could have made 545 pips there, 545 pips there, and I'm going to look to limit out at price point 1.6800. 1.6800 is going to be my target. Now, that's going to be a future high price. Future high price. Now, I don't know if this market is going to break out bullish and then continue to rally, the 5,000 pips towards the north, or the market's going to find resistance and then fall back down to support and maintain the consolidation range. But it really doesn't matter right now. When we get to your high price, we will discover, based upon the evidence, if we're going to be breaking bullish. If so, we'll keep buying. Or if we're going to be falling bearish. If so, then we will take our profits. What I'm going to do is I'm going to look at my 1 hour time frame, and all I am interested in doing is buying counter trend line breaks bullish until 6,800. How far away is that? 1.6800 minus where we are now, 6,400, 400 pips. All I want to do is look to buy this market for 400 pips, or 4,000 US dollars, trading an average pip size of $10. And all I wanted to have is a good, solid equity management plan and trade counter trend line breaks bullish on my 1 hour time frame as long as I'm in the buy zone. Now, when I look at my 1 hour time frame, I will notice, which is the bottom chart, I will notice this market has broken the downtrend. Take a look at this. Resistance, 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 support. Simple. Broke the downtrend line. All I need this market to do is extend bullish, and I got myself a great trade. How do I know the market is extending? Well, I'll just bring in a counter trend line. When or if the market can close above my counter trend line with a bullish candlestick, we haven't done it yet, but if this closes bullish, I will buy the market. I will place my stop 10 pips below the low U-turn, which is going to be 67, 57. Current price point is 6402 minus 6357. That's a 45 pip risk. Risk is 45 pips. Reward will be 3 times the risk. Reward will be what? 150 minus 15, 40, 35. 135 pips away. And 135, we're at 6402 plus 135, 6537. 6537, 6537. And there's the trade. And then once or if this market hits my limit, then I'm going to buy the next counter trend line break, risking $1 to make $3. Stops 10 pips below low U-turns, whatever the risk is, times it by 3. I'm going to do that for the next 400 pips. Hey everyone, thank you so much for watching this series. Hopefully it put things into perspective for you. We did a tremendous amount of thought process behind this. Hopefully you're kind of looking at this and you're kind of saying, wow, you know, this looks like something that I could do. This looks like a very valid resource or area to where I can make consistent income. The market is very readable. I just have to learn the skill to read it. So have any questions, leave it in the comments below. We'll be more than happy to answer them. But on that note, every day, helping traders find a way. It's Joshua Martinez out.